Funded, okay? How do you get your funding?
Good morning, everyone. My name is Margie Russell, and I'm the Executive Director of NYARM. A little bit on how I recommend you use these meetings. Those of you who are here should be taking it back, in essence, to your management company, and when you have your monthly management meetings, you take one of the selections from a previous meeting, and that is your in-house education. So we want to complement your in-house education with what you do here. So our recommendation is that at least one or two people from every management company should be here. Bring all of the issues that your company has on the topic at the moment. Then, at a monthly management meeting in-house, you train your entire staff using the YouTube video, and you would have immediately have gotten the questions answered of the issues of your company. Okay. So that is my recommendation, that you want to come here, but bring it back to your office. Now, how we're going to manage this meeting is we have a mic here for questions, and I have a handheld mic in the back. So if you're in the back and you have a question that is completely on point at the time that the speaker is speaking, feel free to raise your hand, but we want it captured on the microphone because everything is filmed on YouTube now. And it's very important that we don't have these long batches of silence where the listener is straining because it's very frustrating. So we really need to capture the question as well as for the audience. So if you have a question, you can just go up to the microphone and the speaker will address you at that time. And then we have a panel of experts who at a certain point may want to add or interject, or at the end of the particular speaker, they can do that. And so let me give you the names of who our panel of experts are. So we have Stephen Beer, a partner with Sarsdiski and Beer. Stephen, okay. We have Alex Weiss Engineering and Consulting. Okay. And we have Jerry Niemeyer, who is a vice president with Nation Star Mortgage. And so his position with the bank is when someone applies for a loan for their apartment, managers know that there are forms that we have to fill out for the building to satisfy the bank. So they say, do we want to finance any apartments in this building? Okay, and so his job is to make sure that your building is cleared. Okay, now let's see, so we have Stephen. Okay, then we have Greg Carlson, who's going to come up in a minute as president. We have Jeff Howard, who's a board member, and another board member here, Peter Laird, with Caleb Management. Okay, so Greg, you're going to come up, and then I'm going to do a quick introduction on the speakers. Okay.
I just want to say that in early November of this year, I've had the honor and the privilege to be elected the president of the National Association of Housing Cooperatives, which represents all cooperatives throughout the U.S. And so I'm looking forward to bringing some of our issues that we have here to the national focus. The other thing I just want to talk to you about very quickly is that due to Sandy, the mayor had put together a task force called Resiliency. They have passed 4 bills. And that may or may not have an effect on us because the bills were passed and they're leaving it up to the department to write out the regs, which is the devil's in the details. So we don't know. Some of these things have to do with raising your equipment from the basement and actually raising it, but there's a very, very long compliance period for that. And it has to do with those type of things to try to mitigate any damages that if we have another big storm. We don't know who it affects, don't know if it's new building, existing buildings, and they also talk about a lot is this FEMA 100-year-old flood zone. All right, those are in the 100-year-old flood zone. But they keep on, you know, FEMA is going back and forth. They're changing the flood zone maps, and that hasn't been really finalized yet. So hopefully we'll get to the table and talk to the department that is putting together these rules and regulations, so that it will only affect those who need to be affected in these changes, because you're talking about unfunded mandates that we've been living through for the last 4 years. This one will also be very costly. So we will keep you up to date, and I wish everybody happy holidays, a happy new year to you and your family. Thank you.
Thank you, Greg. Congratulations, but we're definitely going to make well use of that at NYARM, your connections, and they've helped us a lot. You all have these packages on your table, and in the industry, what we're doing now when we suspect there's mold on the ceiling, or if we think we have bed bugs, there's ways that we find out about it. We call in the tester to take a sample of the mold, and they send it to the laboratory, and then we get an answer back. And the best way is to test for DNA. And so those are the kind of tests you want to know if that space still has evidence of bed bugs in it. So from time to time, organizations sell things so they can finance what they do. We run golf outings, we run dances. Some organizations sell insurance, some have expos. And so this opportunity came to NYARM, where you can purchase it through NYARM at no higher cost than if you would through any other distributor. And so we'll be talking about this a little later, but that's what this is all about. This is going to, when Phyllis talks about the mold laws, this is going to help you react faster, so you don't get into a lawsuit and you don't, break any laws with that. And when Jay talks about having your building be in compliance, this is an answer to some of that as well. So we'll talk about that a little later. Before we get the meeting started, we have a couple of announcements to make. And we're going to start with Eve Martinez with the Department of Sanitation. Eve?
Thank you very much, Margie, for having us here. I'm Eve Martinez. I'm with the Department of Sanitation in the recycling unit. And I'm here to promote and let you know about our 3 apartment building based programs for managing your recycling and the 2 other components of your waste that are becoming more and more important to the market, economic market, and to the toxics market. And that the former is textiles and the latter is electronics. And we've developed this apartment building suite of programs. The Apartment Building Recycling Initiative, which is a hands-on tech support program for training your building staff and your residents and helping you set up a best practices apartment building recycling system inside your building for the basic New York City curbside recycling program. And then we have for textiles, for which there is an increasingly growing market for these materials, which we do not collect in the curbside recycling program. We have a really very popular and very convenient program in building collection program called Refashion NYC. We partner with Housing Works, which is a nonprofit that provides housing to people with AIDS, where we put a bin in your building, and Housing Works comes when the bin is full and takes the materials away. And the third program is eCycle NYC, which is for electronics, which in 2015, by state law, is going to be, our electronics are going to be not allowed in the residential waste stream. And so we figured one way of helping apartment buildings deal with this new law was to create a similar program to Refashion to provide either a bin in your building, or you can allocate a room in your basement where residents can say, here's my old computer, I have a new one. And again, you call the vendor, they come and they take the materials away. And it's a win-win-win situation for the residents, very convenient for them, for you, for your apartment buildings that you're managing, because it's less materials that your building staff has to drag out to the curb, and it's a win situation for us at the Department of Sanitation, because these materials aren't ending up in the trash, which we have to pay by the pound, to take out of town. And so I'm going to stop here, but I will be here and I'll be passing around amongst you for the rest of this event to talk to you, anyone who's interested. And there are materials and brochures on all these programs, plus information on what and how to recycle, just for your own edification. I'm really happy to be here, and thanks again, Margie, for having me.
Thank you, Eve. Now, a little later, Jay Hack is going to explain that if you don't follow the laws of the Department of Sanitation, technically, you will be in default of your mortgage, but he'll explain that. Next is Luke Surowitz from New York City Clean Heat, and he's going to explain to you why, if your boiler and burner are not updated with certificates, Jay Hack will explain why you're going to have problems with him, and Luke is going to tell you how he can fix that for you, okay?
Thank you, Margie, and thank you to NYARM for having me today on this really cold day. So heat is definitely on everybody's agenda, and we're all thankful to have heat. But while we are heating our buildings, we have to remember about the new local law 43, which basically phases out number 6 and number 4 heating oil from all boilers in New York City, from all the larger buildings that are permitted by the DEP. Maybe I'll start out that NYC Clean Heat is a program out of the Mayor's Office of Long-Term Planning and Sustainability, who I'm representing here today. My name is Luke. And basically, if your building, whether you're an owner, manager, a contractor, if the building you're working with is still on number 6 oil, you have basically until the end of the permit to convert the building to the cleanest fuel available. Now, we as a program definitely encourage people to use either number 2 or natural gas if available. Also, biodiesel is an option. So if anybody in this room has yet to talk to us, the program, I encourage all of you to, introduce yourselves to me. The program is completely free. It's from the city. It provides free technical and financial assistance to anybody that's still dealing with this boiler issue. Now, if anybody here is still burning 6 and their permit is expiring sometime in the future, the last permit will expire in 2015. It is now you're already late getting to the show, in my opinion. Especially if a building is considering a conversion to natural gas. Those conversions take a long time to complete, in some cases over a year, which is why you can see it quickly puts us into 2015. So I'd encourage you to talk to me. Also, natural gas is cheap right now, but there are also other options. Number 2 oil conversions are relatively cheap. Number 2 oil prices have dropped significantly since last year, and this heating season, during certain times, actually number 2 oil fell below the price of number 4 oil. I encourage you to talk to me about that too. Those conversions take very fast to do, and you could also save some money with the efficiencies that you gain by burning a cleaner heating oil. There's electrical components that come out of the equation that you still have to do with number 6 and number 4. There are efficiency gains that you gain by burning a cleaner fuel, and of course the price, which I already talked about. So please come and talk to us. We'll be happy to work with your building, your manager, whoever, to kind of lead you through the process, connect you to whatever financial options there are out there from all the different agencies and private entities that have partnered with us, and we'll get you to burning cleaner. And of course, this whole program is started to clean up the air in New York City. And some of you have heard the announcement from the mayor's office a month ago or so. New York City's air is the cleanest now it has been in 50 years, and it's actually due in large part to this program. So thanks very much.
Thank you, Lou. Now, for the main part of the event. Okay. Well, we have two very prominent attorneys with us here today. Jay Hack, partner with GALLET Dryer Berkey. Phyllis Weisberg, partner, Montgomery, McCracken, Walker, and Rhodes. Jay is his specialty, his focus is banking, and he is going to explain to you how non-compliance with the covenants of your building's mortgage, what it means to you personally and to your building. And Phyllis is going to speak about mold laws, as well as a new law that was just signed and effective immediately as to posting emergency information, creating the emergency evacuation information and posting it in the building. Similar to what I call the sticky signs on the back of your door now, where they only used to be in hotels, and some years ago we now had to put them in apartments. And just like the don't take the elevator, take the stairs sign. So we've got to put some real thought behind that. And at the end of the program, we're just going to hear 2 minutes from a fine young man, raise your hand, from 32BJ. 32BJ has put together a course for your building service workers so they can develop the skills to help you create these plans. So when you sit down and figure it out for your building, one, we want you to send your staff to the class at 32BJ, but engage them, because your staff is thinking about it all the time. All right? So, Jay, with that, I'll leave it to you. Welcome.
Good morning. I want to thank NYARM and Margie for inviting me here to speak to you. As she said, my name is Jay Hack. I am the chairman of the business law section of the New York State Bar Association. That's 4,300 lawyers. It's the second largest subgroup at the Bar Association. I'm a member of its banking committee, its securities committee, and its derivatives committee. That means that I spend a lot of time with the evil empire, but we'll get into that in a minute. I am also a partner and a member of the management committee of the law firm of GALLET DREYER Berkey. You probably don't know me, but you may be familiar with the firm. I suspect that we probably represent a number of you or your buildings. My partner, David Berkey, is the vice chair of the real property section of the Bar Association, and Mark Luxembourg of our firm is the president of the Council of New York Cooperatives and Condominiums. They do that. I do banking. I've spent 37 years, roughly, give or take a little few months. Your banker will sometimes, or often, do things that you find slightly irrational. You're paying your loan, but you're doing other things that they don't like. Like the classic example being, you didn't give them your financial statements, and you say, I don't care why do you care whether you got my financial statements? I'm paying my loan, I paid my loan on time for 5 years. What I'm going to try to do today is allow you to get into their mind and understand the thought process that they have, that they are, in some respects, stuck with in dealing with you on your loan, so that you know, first of all, what's going to get you into trouble, and second of all, some avoidance techniques. The most important thing to recognize is that the bank is not your only counterparty. They're not the only people sitting on the other side of the table from you. The biggest other counterparty is their primary regulator. That's either this New York State Banking Department or I'm sorry, it's 37 years, they changed their name. It's the New York State Department of Financial Services, or the Federal Deposit Insurance Corporation, or the Federal Reserve Bank of New York, or the Office of the Comptroller of the Currency. Now, those regulators define how banks have to function. And most importantly, and I won't use the fully off-color version of this, they come in every year to 18 months and they do an examination of the bank. The fully off-color version, which I won't use, does involve discussing what it's like to have a 6-week colonoscopy. But trust me, no bank, they come in, and for a small bank, they spend 6 weeks. For Citibank, over on 53rd Street, the bank regulators have a full-time office in the Citibank headquarters, and every day they're looking over people's shoulders and looking at other orifices to try to make sure the bank is doing what they're supposed to be doing. And what they're supposed to be doing with respect to loans is monitoring the loan carefully. And what does that mean? That means do an assessment of the different sources of repayment for the loan. You think when you're looking at your loan, again, I'm paying my loan, leave me alone. No. The bank has to, excuse me, I really did. I spent 2 hours with the Securities and Exchange Commission and the Federal Reserve Bank in New York yesterday. My voice is really shot. Sorry. You have to recognize that a bank is going to look for multiple sources of repayment because the regulators want them to look for multiple sources of repayment. They're going to look at the income from your building, and what happens if the income from your building dries up? They're going to have to look at the value of your building, and that's the secondary source of repayment, and that's the collateral. But what happens if there's a flood, or there's a fire, or there's environmental contamination? Well, then they're going to have to look for insurance. And maybe you're going to have, not common, obviously, in co-op underlying mortgage loans, but in a lot of loans, you're going to have guarantors and other personal liability. So you've got at least 3, and oftentimes 4 or more sources of repayment. You've got the income from the building, you've got the value of the building, you've got insurance if the building falls apart, and you've got personal liability in some cases from businesses or individuals who are involved in the loan. So, what does the bank have to do? It's got to monitor whether or not those sources of repayment are still there. What does that mean? Well, let's take one simple example. Financial statements, which are the biggest problem. They ask, your loan documents undoubtedly say you have to give annual financial statements. Maybe they require quarterly financial statements, maybe they require rent rolls, all sorts of different things, depending upon the nature of the building. They may require financial statements of underlying tenants even, or they may require financial statements of your business if it's an owner-occupied building. All of those things are required. And you think, well, I'm paying my loan, leave me alone. No. Why? Because when the bank, and the bank may even be willing to say, it's okay, I trust you. You paid your loan like clockwork for 5 years, I'm fine with that. You don't have to give me your financial statements. No, because it doesn't work. And why doesn't it work? Because what's going to happen is when the regulators come in with their colonoscopy every year to 18 months, what they're going to do is they're going to look at the bank's compliance, at the borrower's compliance with loan covenants. They're going to take a look and say, okay, bank, are you monitoring these loans? Are you doing an annual review of every loan in your portfolio? Are you collecting the financial statements and then looking at them and deciding whether all of those nice sources of repayment are there? I have one client, they're actually only about 5 blocks from here, small bank. They have a couple of branches, not a lot of loans. Every single month, they have a board committee, and the board committee gets a chart, and it lists every loan, every commercial mortgage loan that the bank has, and it lists whether or not the borrower is compliant with about 6 different covenants. And if you're not, you get a pink box. It's like a spreadsheet, because they like spreadsheets. And every bank, every borrower who is not in compliance, his little box gets pink. And there is one director, I won't mention which one, but he is an executive officer of the Super Bowl 2014, who go, I can tell you great stories about that afterwards. He's a good guy. He counts the pink boxes, and once a month at a compliance committee meeting, and everybody knows he's going to do it, he said, they turn to him and they go, okay, how many pink boxes are there this month? And he will tell you. And pink boxes means loan is not in compliance. Why do they keep, with the financial statement covenant, green boxes are insurance, and yellow boxes are something else. But it's always pink boxes because they're the worst. And why do they care? They care because when the regulators come in, the regulators are going to look not at the pink boxes, they're going to look at the files. They're going to spot check all of the loan files. And if, God forbid, your loan is past due, they're absolutely going to look at all of those. I mean, they don't look at all the past due loans at Citigroup because they have $10 billion worth of past due residential mortgage loans. But at small and medium-sized banks, they will look at every single mid-size and large commercial mortgage loan. They'll take the file and they will look for financial statements. They will look for insurance. They will look for all of those things. And what happens if the bank doesn't have it? Well, let me give you a rough idea of what it's like when the bank regulators all come into a board meeting and they sit around the table with the board of directors and they say to the board of directors, you people are doing a bad job because you're not properly policing management, because management is doing a bad job because they're not monitoring the loans correctly. Okay? Jobs, bonuses, stairs. I mean, I've seen this happen many times when bank regulators have come in and looked and said, I mean, I actually had a situation once back in the late 80s, just before the savings and loan bailout at a savings and loan, where a director asked a regulator the following question. You've described all these problems that we have. Do you think that the problems are principally the result of the state of the economy and all of the problems in the late 1980s, or do you think it's management? And they went down the list, and every regulator answered the question, and the last one says, it's management. So you want a rough idea of why management is going to push you to do what you're supposed to do? And the answer is because if you don't, someone's going to find about it, they're going to complain to management. So that's where you sit. Financial statements are a big issue. But they're not the only issue. And one of the other major issues, unfortunately, is that this is a flavor of the month industry. You understand what flavor of the month means? It means that in 2009, and 2008 and 2009, the bank regulators all came in and they wanted to know about the subprime mortgage loans that you made in 2007. They don't want to know what you're going to do in 2010. They want to know what you did last year. So let's see, we're going to take a vote, or a show of hands. How many people, or just guess, what do you think the current flavor of the month is for bank regulators? Anybody have any ideas? Remediation. Okay. Anybody have any other ideas? The answer is flood insurance. We never heard about flood insurance prior to last November. Now, they are all over everybody. Did you monitor the flood insurance? Did you place flood insurance if they didn't keep it? Do you look at the maps? Somebody mentioned earlier moving FEMA maps. Absolutely. All the FEMA maps are going to move. Just so that you understand, it's referred to as a 100-year flood is what the zone is. That does not mean mathematically that you're going to have one flood every 100 years. Unfortunately, it was a mistake when they wrote the statute and the rules. They used a term that was misleading. What it means is that there's a virtual certainty that you're going to have a flood every 100 years. I believe that the mathematical relationship, it's been a while, is that you've got a 50-50 chance of having a flood every 31 years. So when Sandy comes in, changes all of the mathematical calculations. They are redrawing the maps. I have one client that has a loan on a SRO 2 blocks from the water in the Rockaways. It wasn't in a flood zone. It was, you know, they were refining it, and the water was about up to here. And speaking of mold remediation, you don't want to know what colors the mold was. But what's happening now, because they always do everything with 20/20 hindsight, is that the regulators are in there and they're looking at everybody's flood insurance. Are you in a flood zone? Are you close to a flood zone? Do you have the insurance? Do you have the maximum amount of insurance? If your insurance lapses, the bank had, for example, if the insurance lapses, the bank has to notify you that the insurance has lapsed. And if the insurance, and if you don't replace the insurance within 45 days, the bank is obligated by statute to force place flood insurance on your building. Now, you usually have contract provisions in your mortgage that allow a bank to force place a fire insurance if you don't maintain your fire insurance, which, by the way, is also a bad plan, not maintaining it. We'll talk about why in a moment. But when it comes to flood insurance, they have no choice. And I have a client that is in trouble now because they didn't realize that they had to force place the insurance. So now, and they were written up by the bank regulators for failing to force place the insurance within 45 days after the old insurance policy lapsed. They were also written up, this was the worst one, because I'm still arguing with the FDIC on this, I think they're wrong. The FEMA map was redrawn, and they have insisted that the bank is required to get the borrower to provide flood insurance when the FEMA moves the target. And there's some question on the rules as to whether that's the case, but if it's not the case now, it's going to be the case next year. I'm just trying to salvage somebody from trouble this year, but it will be the case next year. And the bank's going to have to monitor, and when they move the map, if they move the map, you're on the wrong side of the line, you're going to have to get it. Now, but briefly, force place insurance. You should understand, because this is, it's constantly being discussed, particularly in the subprime residential area, but it's also true with commercial properties. A lot of people say, and I've had borrowers in large commercial properties say, I don't care. You know, I let my insurance lapse because you'd be amazed at how many people were in Europe when their insurance renewal bill came in. It's just unbelievable how often it happens. Maybe like 30% of all borrowers were in Europe when the insurance renewal came in. But then, and they say, I don't worry about it because I know you have all sorts of forced place insurance policies. The problem with that is twofold. First of all, it's expensive. Forced place insurance is about 6 times as much. The examples that I've seen is regular insurance. And second of all, it doesn't insure you. It only insures the lender. That means if you have a $5 million building and the lender buys $3 million worth of forced place insurance because that's their loan amount, their loan gets repaid and you get to pay for the demolition costs of the building, which, by the way, as an aside, is also a municipal lien, so it gets expensive. You don't want to let your insurance lapse because you're not going to get, what you're going to do is you're going to get on the bank's blank, Margie told me I had to clean this up, you're going to get on the bank's you-know-what list because you didn't provide your financials, or you let your insurance lapse, or you let your taxes lapse, or any of those kinds of things, and you didn't clean them up. You have to be cognizant of the fact that logic, and I'm paying my loan, and I'm a good guy, and leave me alone because it's really not that important, and I'll take care of my taxes. I just need a little nice. It sounds good, and if the banks could look at it in a vacuum, it might work, but they can't. Not only do they have bank regulators, they also have accountants, accounting rules. They have independent loan review. That means one of the things the regulators require is they require the banks to go out and hire an outside company to come in and look at all of their loans and rate their loans. See, loans get rated. Every loan has a rating. The most common rating system is nine different levels. I think it's probably the most common. The number 9, which is, number 9 is loss. Loss means that that loan is so useless that I can't even put it on my financial statements because it would be misleading and fraudulent. 8 is doubtful. That means I'm going to lose some money on this loan, but I don't know how much yet. Number 7 is substandard. Substandard means this loan's got a problem, and there's a reasonable chance that I'm going to lose something, but maybe not if I work really hard. Then we have special mention. Special mention is there's something wrong with this loan. It's really not fundamental, but I better clean it up. And then we have watch. Wow, 98765. Watch is 5. What does watch mean? Watch means there was a bad article in the newspaper. He didn't give me the financial statements. He didn't comply with some other non-economic, non-fundamental covenant, because not buying insurance is probably going to get you special mention, but you're on the watch list. The watch list is called the watch list because we clean it up, but everybody refers to it as the watch list. It's the you-know-what list. You don't want to be on that list. Why don't you want to be on that list? Because one of these days, you're going to refinance your loan. You got a 5-year loan, a 7-year loan, and you want to refinance, and maybe you want to refinance with the same lender, and you want to have a clean record because it's going to be cheaper. The bottom line, you may not know this may not be obvious to you, but when banks price loans, they price loans in part based upon their perceived risk. They don't do, by the way, a very good job of it. They underprice risk, and if you're a risky borrower, you probably get a lower rate than you should mathematically, but they price based on risk. And if you've been a problem for the last 4 months or the last 4 years or for the entire time of your loan, they may be willing to lend you the money. They may not. I've had plenty of situations where banks say, this borrower's just too much trouble, forget it, go away. Do me a favor, find some other lender. But even if you're going to refinance with them, which generally tends to be cheaper, with, you know, assuming that the interest rate is the same, the rest of the costs are cheaper if you're refinancing with the same guy. If you've been a pain in the neck, guess what? You're not going to get the best rate. And maybe it's only going to cost you 1/8 of a point or 1/4 of a point. Not going to cost you 6 points, but it's going to cost you, and it's just not worth the trouble. So what do? You look at your covenants and which ones are really critical. The most important covenants are those, because it's a mortgage loan, that go to the value of the collateral. The maintain the building. You've got to maintain the building. You've got to comply with the laws. You know, it used to be nobody looked at violation. You know, you had a building, you closed the loan, you got a violation search, you gave it to the bank, they looked at it and they, A violations, B, C maybe, depends on what they are. They make you clean it up, you'll sign an escrow, you'll put $10,000 in escrow, and when you refinance 10 years later, you get your $10,000 back because you never dealt with the violations. And it doesn't quite work that way anymore because, again, you've got regulators, you've got accountants, and you've got independent loan review, and you've got auditors, and you've got board of directors, and they're all looking at over your shoulder to try to see what's going on. It used to be, once you closed your loan, nobody looked at violations again because it was just too much trouble. Now, I assume that everybody knows this, I can get a full violation history of any building that any of you was involved in the city of New York in about, 15 seconds? I have, we're up, how at the top of Internet Explorer you have little buttons that say eBay and Facebook and stuff like that. Mine says New York City Department of Buildings. And I push a button and I put in your address and I get a violation search. It takes me 15 seconds. And there are banks I can't say that all of them do it, but I will guarantee you that there are some of them that do it, because I represent some of them that do it. Every year, they go out and they look and they see. Do they care if you have a violation for failure to paint every 5 years with a consistent color in your hallway? No. Do they care when the violation says the upright support steel beam in the building has separated from the cross beam, the wall is bowing out, and it's in danger of collapse? The answer is, yeah, we didn't close that loan. So you bet they care. And they will care about a lot of those kinds of things. So what you want to do is you want to take those covenants seriously, because the lenders are going to be stricter and stricter and stricter, because people are looking over their shoulder. And I'm paying my loan is no longer just an answer to what you want to do. Now, in addition, one of the real problems is an accounting rule. I don't want to get into complex accounting rules, but once your loan is past due, or actually not even, it doesn't even have to be past due, but if you go to your lender and say, I'm having a little difficulty, I'd like to, could you agree to let me pay interest at 3% instead of 6% for the next year and a half? Either maybe you'll ask him to waive it, maybe you'll ask him to just move it to the back end, whatever. I need a little bit of relief. I'm a fine guy. It's a temporary problem caused by the fact that whatever, we have major capital improvements in the building, and I need some payment relief. And the bank may be perfectly reasonable and willing to do that. The problem is that the accounting rules cause an immediate problem. That loan then becomes what's called a troubled debt restructuring. You restructured the debt, and the reason you restructured it was because of financial difficulties of your borrower. Once you do that, the loan is on the list forever. You cannot, under accounting rules and regulatory rules, get it off the list. Once it doesn't matter. You brought everything current and everything is wonderful. It's on the list forever. That means the bank's got to appraise the property once a year. They've got to calculate the net value of the property and determine how much money they're going to ultimately recover on the loan. It is a tremendous pain in the butt. It's probably a day to 2 days worth of work, certainly a day's worth of work for each bank on every loan like that. In addition, if you're past due, you have covenant problems, or let's say real estate taxes. You haven't kept your real estate taxes current. You want to pay, and you come into the bank and you talk to them and you make a deal with them to get some payment relief to bring your taxes current. Immediately, you're on that problem list. And for that type of thing, when you've restructured your loan, you cannot get off. It doesn't matter what you do and how good you are and how current you are. It's not my rule. It's not even a regulatory rule. It's not a banking rule. It's an accounting rule. You can't get off. So what happens is you've got to be really careful, because then look at it realistically. If you're in an apartment, if you're managing an apartment building and you have 100 units, and one of your tenants is a pain in the neck and is constantly aggravating you, constantly a problem. The normal human emotion is to not quite treat them like everybody else. Some people believe the squeaky wheel gets the grease. That does not work. And it's the same thing here. If a bank's going to be at you, if you're going to have to be on their problem list all the time, then then eventually it's going to come back to haunt you. Sure, if you can't, if you can't make the payment, or you can't keep the insurance, or you can't pay the taxes, you can't. Everybody recognizes that happens. But to the extent that you have choices to make, complying with the covenants is a good idea. It is an important thing to do because of all of the different constituencies that cause you a problem. The other thing that there are two things specifically that I want to mention. One is the maintenance and repair obligation, particularly it's very common in co-op buildings. The building doesn't want to assess a lot of money for major capital improvements and other types of major repairs. This is a problem because, going back to what I said, what is the lender looking at? They're looking at various sources of repayment. And if the value of the collateral isn't being kept up because you're not maintaining it, that's going to be a problem. So you've got to do a reasonable job. Do you have to have the greatest building in the world? No. I actually know one building on Fratelli Avenue. I actually had to drive by it because I didn't believe it. I did a violation search on a multifamily building on Fratelli Avenue in the South Bronx. And it's yours?
Yes.
What's your name? Where it had no violations. I thought the violation search was wrong. I actually drove there, it was about 12 years ago. I actually drove there and looked at the building. It was immaculate. You could have eaten off the stoop in the front of the building, okay? No. It was, by the way, the very good borrower, and despite the fact that it was not in the greatest neighborhood in the world, he got the best rate. That's where the whole thing started. He got this phenomenal rate from the bank. Why did he get a phenomenal rate? I didn't know. The bank officer was a friend of mine. Said, hey, he's a great borrower. This guy's unbelievable. His billing is fantastic. It's wonderful. We get the violation search. I honestly thought that it was a mistake. I thought that they had the address wrong or something. Because there's no way you're going to have like a 30-unit multifamily in the South Bronx that has no violations. The place was immaculate. And it saved him money. I don't remember what the loan amount was. You might recognize the guy's name. I'm not too sure. It was 12 years ago. But so that's one. The other thing is, going back to what I said about the flavor of the month. The problem with trying to assess what the flavor of next month is going to be is that the regulatory approach is to always pick the flavor of the month after the disaster has occurred. And we have every decade there is a banking collapse and disaster in the United States, and it just happens. In 1979, 1980, there was a banking disaster which resulted in closing a lot of banks, savings banks in New York, because interest rates went too high and everybody had long-term fixed-rate mortgage loans. So what happened? Starting a year later, the bank regulators went after all the banks and said, you have to deal with what's called interest rate sensitivity. In other words, if rates go up, what's going to happen to your loan program? That's where adjustable rate mortgages and 5.5 and all those came from. Then, 10 years later, 1989, 1990, you had the savings and loan crisis and $600 million residential reconstruction, whatever RTC stands for. Bailout, and what happened? Banks can't do real estate and all those kinds of things. They did skip the 2000 dot-com crisis mostly in this area, although there were some problems in California. We got lucky. But then again, 2007, 2008, the next decade, we have subprime loans. And in each case, the rules changed and the regulatory approach changed a year after, 2 years after the catastrophe. So it's difficult to say what the next flavor of the month is going to be. But when we look at it and when we think about it in the context of conversations with regulators and what's going on with buildings and the nature of the political climate, the one thing that we do know is there's a pendulum. When the economy is horrible, the regulators don't worry about consumer issues. They worry about core financial issues. When the economy improves, the regulators are beating the crap out of you over things like fair lending and truth in lending and all that compliance. When the economy is really horrible, they don't give you a pass, but they're not as tough on the banks because they recognize the core issue is making money. As the economy improves, we believe that they will refocus on consumer issues. And what are those in the context of this whole issue? Well, mold, and bed bugs, and environmental contamination, green energy, all of those kinds of things. My guess, it's a guess, I admit it's a guess, but I've been doing this for a long time, is that 5 years from now, because this is going to become a big issue, 3 years from now, 5 years from now, bank regulators are going to be all over everybody. I'm actually seeing it a little bit with respect to mold already, because one of the things that every bank was required to do was to go in and inspect every building that was flooded in Hurricane Sandy and do an assessment of whether or not that loan had to be downgraded on their 1 through, by the way, the 5 I gave you were the 5 bad ones. There are 4 good grades, but whether or not the loan had to be downgraded, and regulators came in and said, well, did you inspect it? How many did you look at? What did you find? Did you talk to this person? And did they need this? And did they need that? So that's already started. I've had a lot of regulators talking to me about mold. My partner is a mold fanatic. He loves to litigate mold cases, but he's always on the other side. So we get along. There's going to be green energy discussions. Because politically, and again, when the economy gets better, that's the kind of thing people are going to focus on. They're going to focus on environmental contamination and bed bugs and the quality of the experience of the occupants in the building. So if you want to get ahead of the curve, focus on those things and manage those things and get your people to where they're the bank's poster.
Well, this would be a good moment to find out if any of the experts have a comment or a question. And you've got a microphone right there on either side of you. Very good.
As far as regulatory-wise or otherwise, is there a difference between banks and other lending institutions like insurance companies, pension funds?
Yes. The pension funds, each one has a different set of rules and a different set of regulators. Although there's huge convergence between banks, insurance companies, and securities firms. Thank you very much, Citigroup. The brief history lesson is that when Citigroup decided that they wanted to buy Travelers and they bought Travelers, that purchase was illegal. And they had to divest themselves of it within 2 years, and everybody knew it was illegal. So instead of divesting, this was the plan. Instead of divesting themselves, they went to Congress and they changed the law. Only that's what happened. They adopted the Gramm-Leach-Bliley Act, which allows holding companies to own insurance companies, banks, and securities firms, was adopted because Citigroup wanted to buy Travelers. Now, the truth is, the only reason they wanted to buy Travelers was to get that cute little red thing, because they sold Travelers right after But, yeah, there's a fundamental difference between the different institutions based upon who the lender is. Pension funds have the least regulation, because pension funds essentially are regulated only by certain common law trustee obligations, because pension plans are trusts. So the person making the decision at the pension plan has a fiduciary duty to the plan. And once you get beyond, they can't self-deal, and they can't do those kinds of things. They're called prohibited transactions under the ERISA, which stands for every ridiculous idea since Adam, by the way. So pension plans are pretty much free. Insurance companies have a regulator, but they're less strict because of the nature of insurance, the capitalization of insurance companies and the nature of the risk. Insurance companies inherently take risk. It's what they do. Banks are not supposed to take risk. Banks actually have a very, very fine margin. The bank margin is at most 4.25%. Insurance companies have a larger margin, but they take risk, they have larger capital. So insurance companies can.
Okay, Jerry Niemeyer?
Yeah, Jay, this is great. I don't play in the area of the commercial lending of the underlying mortgages, but as a share lender, have been doing this for the last 15 years. I've learned quite a bit from it. And I was amused by your flavor of the month because we've gone through the same thing. In fact, flood insurance, I dealt with that in 2004 with a bank you just mentioned. But one of the things, is that co-ops and some condos as well, if you're not doing what we need to do by looking at our investors who are taking these loans, such as Fannie or Freddie, yes, you could be refinancing your loan and you might have been doing everything just fine.
I'm the moving target, which is when it's necessary to comply with the Fannie and Freddie rules with respect to co-op.
We hadn't rehearsed this, by the way. But is that there's going to be some buildings that we are not going to be able to do that we've been doing before, whether it be condo or co-op, because the new guidelines don't permit us to do that. So some people may be turned down.
Yeah, I'm glad you mentioned it. By the way, we didn't. I've never met this gentleman before in my life, and I've never talked to him. But it's a very good point because one of the big issues, 4 or 5 years maybe, is capital reserve funds.
On condominiums.
Yeah, and co-ops, in the financial statements on co-ops.
Well,
but yeah, like I said, it's a moving target.
well, and also you have different banks and they all have different interpretations of what the guidelines are.
Yeah.
And
If I could interject, for those of you who want to know when these
Okay, I think that mic needs to be on. Yes, Phyllis, please do.
Thank you. For those of you who want to see those guidelines, which change regularly, there's something called the selling guide, Fannie Mae's selling guide. Last time I looked at it, it was about 1,100 pages long. And it changes, and it's got underwriting standards not only for borrowers, but for the property. So that you have, at one point, any building which was involved in any litigation was disqualified, and there could be no loans on that property. That rule has been changed, but in my view, not a meaningful way, because I represent a lot of co-op and condo boards where they have had problems because of that, and the buildings effectively are blacklisted, which means that none of the shareholders or unit owners can get loans in there, which means no refinancing, and on sales, the building has become an all-cash building. So it really is something people should know more about.
Yeah.
if I might add one point, is that you can see the guidelines in all regs. You can see all the 1,000 pages, whatever they are. But then there's a whole set of hidden guidelines that are in every lender's contract with Fannie or Freddie that you do not see.
Yeah. You've got, again, by the way, just the seller guide, just so that you understand that, the seller is the lender. Because it's called the seller guide because the lender sells the loan to Fannie Mae. I just want you to understand that if you go and you look, you can get it off the website. And it used to be only like that thick, but I guess now it's this thick. But it's the guide for what lenders have to comply with in order to sell a loan to Fannie Mae. And if you don't, you can't. And if you don't, if you sell a loan, because Fannie Mae doesn't check every building, but if you sell a loan to Fannie Mae, I have a client with a little bit of this problem. If you sell a loan to Fannie Mae that does not comply with the guide and the loan goes into default, guess what happens? They give it back to you. They give it back to you for full value, even though it wasn't. It's for full amount, even though it's not worth what they give it back to you for. I have a client that lost a couple $1 million on that because of what they sold in the latter part of the last decade. But yeah, you got the big one. The litigation one was just crazy. Everybody, when they came out with that, everybody beat them up. They changed it, but not enough. But the reserve fund is another one. And they want you to show the reserve fund on your balance sheet. And if you don't have the reserve fund on your balance sheet, Why? Well, because then you're not going to be able to maintain the building, the value of the collateral is going to go down, blah, blah, blah. And if it's a co-op, maybe you're going to have to increase maintenance and increase burdens on the borrowers. So it's a problem. You have to play the game.
Okay, so I think it's time to move on to the next segment with Phyllis. And so,
Can I just
and you can fit, yes. So Phyllis, get yourself ready. And Stephen, I'm sure you're going to want to say something maybe after Phyllis is done. And Alex.
I brought these cute little things here. My firm publishes a quarterly newsletter, and since most of the guys in my firm are real estate and condo and co-op people, we have appellate court partially removes important protections for individual members of co-op and condo boards. We have a commercial, these are different issues, a commercial real estate tenants checklist, and this one, which is mainly about the Tax Reform Act, is when security and privacy concerns clash in multifamily buildings. I have a few copies of these, but we distribute them in paper form, but mainly now we're distributing them by email. And every issue has one or two, or sometimes all of the articles about real estate, multifamily buildings. I've got a partner who's an expert on construction loans and mechanics liens. If any of you would like to be on the distribution list, just give me a card or write your email address down there, and I will put it on. Our next one is, my deadline for writing my article is next Tuesday.
Thank you very much, Jay. That was excellent.